Hello everyone, this is the next episode of the Nomad Capital. Today with me it's Logical Thesis. I have been a subscriber to the Logical Thesis for around, I guess, 3 years. First time I found your Twitter account was when I was researching the small cap called Atlas Engineering. I don't remember, I think it was 3 years ago. So we were both invested. I think since then, none of us have the position. And yeah, I've been following you for a long time, learn a ton, understand a lot of the companies I've never heard of. And yeah, so Logical, why don't you introduce yourself to the listeners?
Yeah, so I still go by my anon name of Logical Thesis. At some point, I will be more, or I guess I should say less anonymous, but I'm 32 years old. I've been individual stock picking for about 6-ish years or so. Obviously, like a lot of other investors, had more time one working from home back in the
Mm,
COVID days, so I took it a lot more seriously. When I find something that I like, I get a lot more obsessive with it. And stocks just kind of fit that criteria of a passionate hobby, as well as, not just something that I like to do for fun or like time consuming, but I enjoyed it. And it was also a good financial hobby, obviously. So that's what
mhm,
kind of got me into it. The numbers of it really sticks with me. I am a math guy. I have a math background. I studied undergrad at UCLA in computational mathematics. I'm
mhm,
getting my master's in data science. So I've really been in this quantitative field. But the truth of the matter is, I actually rely a lot more on my qualitative analysis. Obviously, when I look at the numbers, I pay
mhm.
attention to the analysis of those numbers and seeing how things trend over time, and could I extrapolate out this trend of this business's revenue, et cetera. And the numbers really sit well with me, and I can like very quickly compute those in my head, and that's the math part I like about it. But then there's like this common sense aspect of it too, for like the fundamentals of like a business. And so I've always enjoyed that part. That's kind of what got me going, and I've evolved over time of what I pay attention to. Like, before we start recording, I was telling you that I've been getting more into technicals of stocks because they provide good risk management kind of barriers. And so that's kind of what I've been doing, is intertwining as much information as I possibly can. The more confluence of information I have, the better decisions I can make, and the more quickly I can make those decisions. Because I can listen to a stock pitch, and
Mhm.
in 30 seconds I can basically tell you yes or no. And I think that's what I'm really good at, is like I know there's a lot of people that spend tons and tons of time with stocks, and that's also a different thing where people are really good at that. I just flip through. I think there's like a saying where the person who flips over the most rocks wins, and
Mhm.
so I flip over hundreds of rocks, a year. So I just try to get, and then that way I can kind of familiarize myself with as many businesses, understanding as many industries. Like, let's say I study a stock. And then because of that, I'll study all the other stocks in that sector. And then I'll start getting a quick understanding of like, okay, relative valuations based on growth prospects, next 3 years, free cash flow margins, et cetera. And then all of a sudden I know about six new stocks, not just one. And so it's just really, it's a lot easier to understand when you have more context and a baseline of that sector, for example, to be able to decide, is this a good investment or not? And I'm a generalist. I've been all over the place. I don't really have like a specialty, but I think just understanding one, like stocks and the sentiments that they trade on, but also the underlying businesses. And I think simpler businesses typically pan out better in stocks. And so, yeah, sorry, I probably went on a tangent, but that's kind of what I enjoy. Sorry, I don't even remember what you asked me. You said,
That's perfect. Yeah, I just asked like a little bit, give you a little introduction to the listeners. Yeah, I will have some follow-up questions, but first of all, I am really curious myself. Whenever I have a guest, I want to ask them like, how did they started investing? Like, for example, why did you choose to invest? What was your first stock you picked, and kind of lessons you learned since then? For myself personally, the first stock I bought was the company called Air Canada. So airline, non-profitable. I just bought it because my friends told me. Of course, I lost 30% in 3 years, but it was a good lesson. Never just blindly follow what people are telling you. Do your own research, understand what you are investing in. So yeah, I just curious like how this journey started with you.
Yeah, like I said, obviously I got a lot more into it during the COVID times when we are
Hmm.
all stuck at home. But Yeah, I guess that's when I started going for more like ETFs and whatnot. Because like, so if you ask me like what's the first stock I bought, it was probably like URTH, which is like the world index, and that was just kind of a way to get exposure to
Wow.
equities. But yeah, but that was like before I got into like actual stock picking and stuff
Hmm.
like that. If I'm being honest, I don't even recall what the first stock I bought was, but I can talk about my first successful stock, which happened later in that year of 2020. Which I mean, obviously a lot of stocks did really well that year, so it's
Hmm.
not saying much, but. This one, so obviously, like a lot of other fundamental investors, I started off with like Peter Lynch, and so does everyone, right? Everyone reads One Up on
Yeah.
Wall Street, which is probably the best book to start with. And
Greatest book.
yes, of course, and I used to revisit it all the time. So, you know, I know it's a cliche, but sometimes cliches are a cliche for a reason because they're very good. And he would always talk about find something that's in your backyard. The ugly name is better, understanding the price you pay for an investment, that kind of thing. It's very simple. Obviously, I was more of a simpleton back then. I didn't have all these, technically savvy kind of things. I was just very like straightforward and still learning about how to study individual businesses. But a friend of mine, this was just like during peak, COVID times. So he's my best friend. He basically was doing like blood testing for because he's in biology, so he used to do like he worked at like some laboratory,
Hmm.
and all of a sudden they were hiring all sorts of people. He was like, dude, I'm getting like crazy shifts right now, like it's going crazy. So I'm like, I started looking up his company, and then I'm like, what's going on? And then I started reading their earnings transcript. I'm like, wow, this is a publicly traded company. It has an ugly name. It's in Los Angeles where I live, and I'm like, okay, this is interesting. Like, he was telling me like, oh yeah, I'm getting asked to come to work all the time, and so I'm like looking up, and their earnings transcript from like their last quarter before he started working there basically was saying, yeah, we're tripling our shifts, we're getting into COVID testing, all this stuff, and it was like a company that nobody really had heard of. It was Fulgent Genetics, so FLGT, yeah, yeah. So that was a perfect fit the criteria of like a Peter Lynch sort of stock, and it was in my backyard, ugly name,
Hmm.
and it felt like something that probably the market doesn't know about, Wall Street doesn't know about, because who knows about this random, you know, blood test lab or genetic
Yeah.
testing lab that's now transitioning into like a rapid, COVID testing lab essentially and seeing insane volume. So I was accumulating shares, and again, I had a very small portfolio at the time, so it wasn't like crazy thinking back now. But I basically was buying shares at like 16 bucks. Then all of a sudden this stock goes to like 21, then 27, and then they report earnings, and their earnings, I was spot on. Their demand was through the roof. And the stock ended up going to like 36.
Wow.
Uh, yeah, and by the way, when it went to 27, I actually made it 100% of my portfolio, and then it went to 36. And then it went to 43. And then I was like on top of the world. I'm like, oh my goodness, I have it all figured out. And the next morning I wake up, and the basically some news came out with Abbott Labs, and they're a huge bio company. And they basically released their 15-minute COVID tests. And the stock Fulgent Genetics was down 33% that day. And so in one day, it just I was on the top of the mountain. I ended up selling the stock. I didn't know enough back then. I'm like, oh, well, I guess the thesis is broken just based on that announcement.
Hmm.
The stock went on in the next 6 months to go to $180, so it's
Oh
6x from
no.
there. So, I made money on the stock. I basically doubled my investment, which I was
Hmm.
very happy about because I had a big allocation. Again, small account back then. I was still kind of learning what I was doing, but I was happy that the thesis worked out. But back then, I still didn't really have an understanding of, I don't know, like understanding sector peers and relative valuations and that sort of thing. And so I feel like I just got lucky, and it made sense because it fit the criteria of a Peter Lynch kind of stock. So yeah, I mean, I thought that worked out pretty well. But yeah, so that was my first stock, and I've been interested ever since. But the wins now are way more consistent. I feel like back then I was kind of just trying to find that next Fulgent Genetics, and it's not always like that. You don't always have to fight for, the 10x return. Sometimes it's a lot easier to say, hey, look, this stock is trading at like, I don't know, 12 times earnings or something, or
Mhm.
12 times EBITDA, and maybe it should be trading closer to 20. And that's like 60% upside or whatever it is, right? So um that's my thought is it's a lot easier now to just find things that might double rather than trying to find like a 10x home run. Like those things are really tough to come by. And you mentioned, Atlas Engineering. I know like that was really cool when we found that stock early on.
I actually have no idea how did you find it because it's trading in a TSX. I think it's TSX Venture, right? And not many
Yep.
people from US even have an access to TSX Venture. You somehow found this company and you decided to like convert USD to CAD and then buy it in a really small venture. Just
Yep.
so listeners understand, the TSX Venture, 50% of this venture is just two spin-offs from Constellation Software. Everything else is like small mining companies or like sub 100 million market cap companies. So yeah, I'm really curious. How did you find it?
Well, I think the biggest value investors on Twitter are probably like people who are interested in more international markets because that's where you're going to find value. So
Hmm.
for a long time I was in the like there's it's funny because there's like FinTwit, which is like all of financial Twitter, but
Hmm.
then there's like sub segments of that, and it's like there's microcap investors, there's technical traders, there's international stock guys, there's value investors, there's growth investors, there's all sorts of pockets, but like when you led from a valuation first framework and then you end up posting about those kinds of stocks, then you end up attracting that kind of crowd. And the more they engage with you, the more you
Hmm.
end up intertwined in that kind of community and that algorithm. So I just kept finding more people that were interested in more value oriented stocks, which, makes sense from an investing standpoint. And then, there's a guy, Deep Sale Capital. I'm sure you've seen his account. He's pretty
Yeah.
big. He's like, yeah, so he probably has like 50K plus followers, and he's a small cap fund manager now. I think he's been running his fund for like 2 years or so, maybe more. But I remember it being me and him would chat a lot. He actually used to follow me when I had like 200 followers, and I'm like, oh my goodness, I've made it. Like some big guy is following me. And I would read his investor letters. I would chat with him, and he would have like interviews with like management. So we would talk a lot, and he would tell me like I remember he had a write up where he wrote about Atlas engineered products, and he's a really sharp guy, and so I was just like he was telling basically they were trading at like 3 times EBITDA, and that just alone was enough for me to say this is pretty cheap. It's fairly
Yeah.
illiquid. It's something that a small guy like me can probably do pretty well because the liquidity is kind of in my favor here. If I was a big guy, then it'd be really tough to accumulate those shares. So I think that probably was my first ex-US stock. I mean, maybe I had other ones, but they were probably trading on OTC. But yeah, like converting currencies and going to a foreign market, that was probably first. And yeah, so that's how I found it, Deep Sale. And then, yeah, I mean, the community was all over it. You saw how it became a consensus stock. And then honestly, while we were right to say that the stock should have probably re-rated higher, which it did,
Yeah.
after that, it was really based on once it reached that proper valuation, then it was a matter of execution. And I think
Yeah.
we can both say that the execution has sort of been lacking. I think, having that acquisition mind frame that they had, the M&A, like they were doing really smart things with capital allocation. They were doing things like when the stock was low, they'd buy back shares. When the stock was high, they would issue shares to pay back debt, or they would buy back, or they would like buy another company and issue shares because there was a heightened valuation on the stock, or
Hmm.
they would, I think the bigger part of that thesis was less about the actual building and more about the financial engineering of the company. So
Hmm.
yeah, I thought that was pretty interesting. And yeah, so. I think, yeah, that's probably how I found it. But there have been a lot of Canadian stocks that have done extremely well in that area. But it's also I've learned over time that it's best to not put yourself into like one specific, like don't pigeonhole yourself. Like if you like a Canadian microcap or a value stock, you can still like growth stocks, and you can still like biotechs, and you could still like a large cap like an Amazon mega cap. Like you can still like everything. There's no reason why you have to be like, there's a lot of people who are really proud about their portfolios being, oh, like I am 100% in micro caps and I own this like, like fintech company in like Kazakhstan at 3x earnings or something. It's like, all right, dude, like cool. I'm happy for you, but like and maybe that works for them, but like I don't know. There was like I kept feeling like in the microcap community, there was a little bit of like, oh, I would never own something that trades at like 10 a time sales. But it's like,
Mhm.
but what if it's like a revolutionary business and their margins are going to expand? And what if their margins are already incredible? And you're talking about like a asset light business, and it's just it's not so straightforward when you're picking stocks. There's more to it than valuation, I guess I would say. So, yeah.
Yeah, I think for Atlas Engineering, it fits the Peter Lynn criteria of going back to your backyard. Because I live in Vancouver, and wherever my work is, when I travel there, I always go through the Atlas Engineering buildings. I was like, huh, it's interesting. And then I saw your pitch, and I was like, well, I have to do more research. And basically, I came out to the same conclusion that the valuation is too cheap. I see their products. I read the financial report. It made sense, especially at that time, the Canada was really in a bad housing crisis, and I still believe it is. So yeah, both the same. For me, it was a little bit easier because all of the Canadian brokers, they support TSX Venture out of the box, so I didn't have to do anything with the currency conversions. But yeah, one thing I wanted to kind of ask you. So in the beginning, you mentioned that you are researching a ton of stocks, and when you go to the specific sector, you're trying to understand the peers. So, for example, in terms of the Atlas Engineering, did you try to check out the other builder companies in Canada, or it was just like you read the pitch, you saw the financials, and you're like, okay, the company is just too cheap to ignore?
Yeah, I think it's the latter on that one specifically. Just because it felt like an undiscovered opportunity. It felt like a name that probably people don't know. And then the capital allocation framework so I read the pitch on the capital allocation framework. That enough was enough to me to sell it. One, you have a stock that's extremely cheap. Two, they're growing by acquisition and they're buying things at accretive valuations. So it's like you didn't need much to go right for you to make 50 to 100% on
Mm-hmm.
your money. And that's exactly what happened. So like, again, like I think there is an importance of having that relative valuation sector wide, but when something's so cheap to ignore, you don't need to do that much work. But also, I will say, and also I was kind of biased because like I was investing alongside other investors that I trusted.
Mm-hmm.
And so, you kind of understand who you're dealing with. I understood the management team. I'm pretty sure Hadi and is it Paul, the CFO? I forget his
Yeah, I
name.
think Paul.
Yep. Yeah, so they both follow me. And we've chatted too. Like, so I know they're sharp guys and everything I'd read. And I'm like, okay, like these guys are solid. Like they're a good management team and that kind of thing. So I didn't need much convincing at that point. I was like, okay, one, deep sales pitch was great. Two, the financials check out. Three, it's really cheap. Four, they have a good go-to-market strategy. Five, they're growing by M&A, which is accretive. Six, they're being smart with financial engineering. I mean, I didn't need a lot to go right to say that this should be trading at like 5 times EBITDA, and then EBITDA is also going to grow. So,
Mm-hmm.
you put those two things together, you have a 150% return, which is basically how it played out. Um, but in general, and also I will say this, right? Like this was 2022, October 2022 when we got long AEP, which is funny you bring up that stock because it almost brings back nostalgia. I still check in on that stock once in a while because I do want to get long that thing, but Canadian real estate is still somewhat of a mess, so
Mm-hmm.
I've kind of steered clear. I think there's better opportunities. Um, I like remembering those days, but at the same time, I like to think back I like to think about like how far I've come in terms of like opening my mind to like more than like I was alluding to earlier, like more than just value names or like cheap valuations. It's more like there's so much out in this market to own, and I'm not saying go buy something at like these ridiculous AI stocks and stuff like that. Like I have very little exposure to any of those. I mean, I might have a couple. I have to think on it, but I mean, I think my exposure to tech is down to like under 20% at this point. So like,
Mm-hmm.
I'm very reasonable when it comes to like my exposure and allocation to a sector, especially if I think the valuations are out of whack.
Mm-hmm.
But valuation alone won't make me steer clear anymore of an investment. Like if it makes sense because maybe they can grow into their valuation. Like I know, I focus on bios a lot, and like I've focused on med tech companies and med device companies, and those things generally trade at like 10 times sales because one, they're probably having 85 to 90% gross margins, which is just unheard of. They probably
Mm-hmm.
have, very clean balance sheets. They're gonna, likely see widespread adoption of their medical device, like Shockwave Medical. I don't know if you ever saw that one back in the day, but that thing was growing 25% top line, had like 90% gross margins, and they were going to have extremely resilient cash flows in a downturn economy, right? Because people are still going to go to the cardiologist. So,
Mm-hmm.
and it was, revolutionary tech. I mean, the way cardiologists that I spoke about that would be like, they still use it obviously to this day because it got bought out by J&J, so it's no longer a publicly traded company. But they would talk about it as like, this is a miracle device. So yeah, I mean, I think opening your mind to like other things, and
Mm-hmm.
Atlas was a great pitch because it was a value stock and they had like a growth engine which would kind of potentially actualize the value that you're about to see. But
Mm-hmm.
you don't need that necessarily to do well, I think. There's a lot to buy out there.
Okay. Yeah, makes sense. Uh, can you can I ask you, so you have a mathematical background and right now you are studying the data science. When you just started investing, and for the listeners, you all just said a lot of the jargon from the financial world, right? Like EBITDA, the free cash flow. So for example, myself, when I started investing, I did pass some online courses just to understand all the terminology. And for me, it was underwhelming. There are so many terms, and even through passing through them, I barely use most of the terms. I basically just care about the free cash flow, about the liabilities, the assets. And many of my friends who are just starting the investing, they also go through the same journey, and they tell me like, I just give up. There are so many terms I just can't wrap my head around it. Like, how can I invest in the stock? So I have to know all of these terms. I'm just curious, how did you approach it? Did you just maybe you did some courses, or you just like read the financials, and then if you don't understand the term, you just Google it and then go forward?
Well, I can say that bookshelf behind me has maybe 30 financial books, and I read all of them in
Wow.
my first year. So,
I thought those are computer science books, to be honest.
uh, there's a good amount of those as well. I have a wide variety. Actually, the ones on the top are all bio and gene, which is my next kind of chapter to be a little bit more specialized in that field. But
Mm-hmm.
yeah, I mean, I read as much as I possibly could when it came to financials and stock,
Mm-hmm.
I guess, investing, just because understanding the base is important. But what I can say too is like the most things you're going to learn, and I know this is kind of cliche too, is to say like obviously people say like 10Ks and 10Qs, and obviously that's a great place to like learn about actual businesses. I think those are a little bit too boring and too meaty for me. Typically, I go to 10Ks and 10Qs when I need to verify some very like specific information that's like a little
Mm-hmm.
bit more in depth. Like for example, like I don't know, maybe like the risks of a business, or maybe like if I need to better understand parts of like the loans on a balance sheet, like if they have like some sort of like senior convertible notes, and I need to understand, okay, when are those notes due? When are because then I don't have to like search through 8Ks or something and figure out like when was that loan issued. I could just go to the 10Q or 10K and I could look at the balance sheet and I could find that line item and I could find the disclosure that says, oh, we have, X amount of loans or X amount of senior convertible notes at 1.5% due in 2030, and it's like, oh, okay, that doesn't matter, who cares? But so I'd say that 10Ks and 10Qs are a great place to learn. I would say that books are good up to an extent, but
Mm-hmm.
the best way that I've learned is, as I said before, is like studying hundreds of stocks a year, because I can understand in a specific industry what metrics matter. And so, for example, like if I go into ad tech companies, like I've always talked about Pubmatic and Magnite, and obviously Pubmatic, screens pretty cheaply, and there's the Trade Desk, which has always been very expensive. But these are the three main, I would say, ad tech stocks. When you read, so a lot of the times whenever I like do research on a stock, I'll start off by like Googling, like MGNI stock for Magnite, right? And I'll look at the market cap, I'll look at like the 5 year performance. Maybe I'll look at like the financials on Google where, you could just see the quick like quarter
Mm-hmm.
performance, you see the growth or whatever, and you say, okay, well, okay, they're trending positive, good, good, over the last 4 quarters. Oh, look, they're accelerating in top line revenue. It went from like 24% growth, 26% growth. I'm just making up numbers. But then it's like, okay, like let me dive in a little bit further into this company because it passed my first filter. Then I go into like MGNI Investor Relations. I'll go to their page and then I'll look up like the latest press release for their quarterly earnings. So I'll read through the press release. And then I'll look at like the high level numbers, like, okay, what are they highlighting? I'll look at revenue growth, obviously. That's the, it's universal for every business. But then what you'll notice is that they'll start highlighting things like adjusted EBITDA. So
Mm-hmm.
ad tech is the first time that I started taking into account and understanding like adjusted EBITDA being like the main metric that they report on.
Mm-hmm.
And that has a lot of reasons. Like they amortize a lot of their costs. They have like like Pubmatic has like depreciations of their servers, of their connected network. So it does make sense that they report adjusted EBITDA, and it tells you the true profitability of the business because adjusted EBITDA is very closely related or correlated with operational cash flow. So it can kind of tell you like on a cash basis, like how profitable this business is. So, and then you look at, the trade desk, and then you look at, Magnite and Pubmatic, and all of them are reporting on adjusted EBITDA. It's like, okay, cool. So now I know that this sector really goes off of adjusted EBITDA. But then you go
Mm-hmm.
look at software stocks, right? And you go look at Snowflake or GitLab, and people say, oh my goodness, these are like, Snowflake is such an expensive stock. And then you look at it from a free cash flow basis, and Snowflake is at a 35% free cash flow margin. So
Mm-hmm.
then you start like understanding like, okay, software pretty much goes off of free cash flow multiples. Ad tech goes off adjusted EBITDA multiples. But the only
Mm-hmm.
way you're going to learn those things, so it's like you asked me a question of like, how did you learn all this jargon? And a lot of it is just reading press releases of earnings reports until I started realizing what is it that the management teams are highlighting. And then that's what I learned for each sector. And like, for
Mm-hmm.
example, every sector has its own like measuring stick. Like if you look at biotechs, for example, and commercial ones, you're going to be looking more so at like peak sales because that's going to determine like the total addressable market of their, based on their total addressable market. Because like for example, like a Snowflake could have a huge total addressable market because, every single enterprise, every single industry could use tons of data. And so their
Mm-hmm.
total addressable market is really big. But when it comes to like treating a rare disease, for example, there's X number of patients per year, and that, multiplied by the cost of the procedure or treatment, that, so their total addressable market is much more limited. So you can't be using like the same sales multiple you would do for like a Snowflake or a software company as you would for something that has a much more limited TAM on the bio side. So every single sector, even though we're generalists, like you need to still somewhat learn about the specific sector to understand what's the measuring stick and like does it make sense based on that measuring stick? Because some people will look at like Delcath systems. I don't know if you've heard of DCTH. It's like
Never
a
heard of it.
it comes up a lot in value circles outside of biotech because it's a kind of a procedure company that got FDA approval mid in 2024, and
Mm-hmm.
they have like 88% gross margins. Their revenue growth is like hundreds of percent quarter over quarter, but that's because they just recently launched, right? So obviously they're
Mm-hmm.
off a small revenue base and that's growing very quickly. But the truth is that it treats a very like very small addressable market of people.
Mm-hmm.
So people are extrapolating the numbers out, probably wrongly so, and to think, oh, this stock only trades at 8 times sales, but 90% gross margins. It trades at maybe 7 times or 10 times gross profit, and they're growing 80% or something. And it's like, yeah, but they're gonna reach that part of the S curve pretty quickly because
Mm-hmm.
they're limited, and then at some point their growth is gonna taper off very severely. So it's like if you don't have that level of context within the sector, you're gonna look at a stock like that and think, oh, this stock is gonna, and by the way, I'm just saying DCTH because that's like I think a common example of something that, I think that was like the first example I thought of, but that stock can still go up from here like at 11, $12 to like $20. I'm not saying that like I think $20 probably makes sense for that stock. I didn't mean to dive into that stock specifically, so I hope nobody hates me for saying it, but I was just more so saying like how people think about stocks, it's really important because they need to understand the sector that that stock is in because that's going to tell you a lot too. And like, obvious. And last thing I'll say is like, I mentioned things like free cash flow margins for a software business, but obviously there's, unprofitable businesses for one. Then maybe you use a sales multiple. Also, there's stock-based compensation. How does that impact the thoughts on the free cash flow? Some people X out that SBC.
Mm-hmm.
There's a lot of ways to look at things, and I don't think it's like there's not one measuring stick for every single stock, I guess is the point I'm trying to make.
Yeah, I think the problem nowadays is with a lot of the financial screeners. So people go to Yahoo, they look at the market cap, the P/E ratio, and that's basically where I guess half the people just like that did their research. So you see the revenue growth, but you don't know what the drug is doing, right? What's the total addressable market or the actual number of patients who need this drug? Or if you look at the for example, Snowflake, I guess most people will just look at the P and say, hey, okay, it's too expensive. I'm not gonna like invest into this. Instead of you doing a lot of work going into the investor relationship, downloading the thank you, reading all this stuff. It actually, it, I guess recently it became a little bit easier because of the AI. Like every time I do the research of a new stock, I download a thank you 10K. I output into the Google ML, how it's called, Notebook ML. And basically I have this conversation with ML basically to understand like, hey, what the main KPIs. Another thing I don't like is if companies is like providing some sort of a KPI for a long time, and then one quarter say, okay, we are not disclosing this information anymore. For me, it's a red flag because this is both the only like huge value I was looking at every quarter, and now you're not giving me information like what's going on there. So yeah, like thanks for sharing that there is like no shortcoming in terms of the learning all the investment jargon. 30 books is crazy. I just did one
Yeah.
course. I don't remember where it was like a free course on YouTube. Uh, I
Yeah,
have
I think not. Sorry, go on.
no, go ahead.
No, I was just gonna say, I think nothing. I guess I'll finish that point by saying nothing beats experience. So you
Mm-hmm.
will only get better every single day that you show up and every single year that you continue to do this. And I think a lot of people think they see probably people make money in stocks and have good returns and think that, oh, I can do that. But it's the truth is that you have to lose a lot of money probably first, or you have to like go through problems and troubles, and you have to like, it's something that you have to persevere through. I think a lot of people might think, oh, well, I could do that too. And, but I think everyone has to pay their dues. Yeah, everyone has to go through financial tuition, right? Like you have to
Yeah.
pay your tuition to the markets. And so there's no shortcut. And yeah, I mean, the more you learn, the more you look up companies, the more you interact with other types of investors. Like, for example, I got into like, let's say, okay, for example, like Snowflake or something like that. The reason why I feel okay, sorry, there's some background noise. I don't know if you could hear that.
No,
No.
I don't hear
Oh,
anything.
excellent. Okay, good. So here's the thing. A name like Snowflake looks very expensive to most people,
Mm-hmm.
and most people would never pay that kind of money or that kind of valuation for a stock like that. But I personally have a background in data, and I've worked with Snowflake and I've worked with Databricks, and so I understand these softwares very well, and I can understand that the TAM is going to be unlimited and it's going to
Mm-hmm.
just continue to grow. And so I think that if you take a short-term view, and again, I'm not saying buy those stocks because I'm not, well, first off, Databricks is private, but Snowflake, for example, like I'm not saying buy that stock, which by the way, it does look technically strong and it could easily go to like $360, I think this bull run potentially. And it's at 220 right now. I actually think that looks like a decent setup, but besides that, that's just a separate point. My point is that like I think people like quickly just look at a PE multiple and think, oh, or whatever the multiple is, they just shrug this off, but they don't really understand. And there's a whole other group of investors who don't even probably know the product that they're invested in. But I think a product like a Snowflake or Databricks is very interesting because for example, Snowflake is going to grow forever. And the reason why that is not only are they going to land new clients that are getting more digitized and collecting more data, and they need to like basically modernize their data that they're having at their company. There's so many companies that have all this data that they're collecting. Forget that. Every single year that you use Snowflake, your data is expanding. And it's a consumption-based model, for example. So I think what people don't understand is that like even if they only land 10% new clients this year, or grow 10% organically in that way, like with new business, their current business is also going to be growing 10% or more. Because like think about this, if you have a company that has 5 years of data and next year you have 6 years of data and it's all
Mm-hmm.
based on consumption. So all of a sudden, your level of use just went on 5 years of data to now 6 years of data. You had already a 20% increase in your own data that you're growing. And so that's
Mm-hmm.
if you already had a Snowflake contract, your own clients are already growing. And that's why they have such high net retention rates
Yeah.
because those clients are spending more with them every year. And that's going to, contribute to their top line. And I think that people don't understand that data is going to continue to grow from here.
Yeah.
So yeah, those valuations are crazy, but it doesn't. I think it's because they're factoring in like 10 plus years in the future. Now, do I invest in a lot of these tech stocks? No, because I still, it's hard for me to underwrite good returns based on the starting valuations. But I
Mm-hmm.
don't think people that invest in them are as crazy as people think. Although I would, maybe argue that some people are invested in these things and they probably don't even understand the real technology behind them. But that's neither here nor there.
Mm-hmm. It's actually interesting because I also have the like, engineering background for myself. Like, I have never been invested in Snowflake, but I am invested in Nebius, just because the Nebius has a stake in a ClickHouse. And I know how good of a product of a ClickHouse because I've been using it on a daily basis. And my personal opinion, I still believe the ClickHouse is a little bit better than Snowflake just because I can run it locally without like spending all those latency. And for you, you said like right now the tech sector, at least in your opinion, a little bit overvalued. And I'm just curious, how did you end up doing the research and buying the biotech? So this transition from a software companies to more of a biotech. For me personally, I have like zero knowledge of how biotech works. For me, it's all the speculations. If I were to invest, I would just buy the what's called XBI ETF. So yeah,
Yeah.
just curious, like to hear your opinion.
Okay, yeah. For one though, I would say I'm not like it's not like I went from software to biotech. No way. I'm barely a software investor. I mean, I've liked some software stocks because I've
Hmm.
actually worked with those softwares. Like I've liked Snowflake, so at
Okay.
110, it was a no-brainer buy at the lows of that range.
Hmm.
Um, there's other companies like Amplitude. I think I did pretty well on that, but there's like Braze software. I mean, some of these things are really annoying to hold. So like sometimes the annoying part about owning software stocks, and I'll get to biotech, but like is that like some of the more reasonably valued ones actually end up having the worst performance. And it's always like the high value ones that continue to do well, like the CrowdStrikes, the Cloudflares, etc. So like the valuation really takes a backseat for some of these companies that are going to end up disrupting the entire industry.
Hmm.
That's because they're going to have long growth runways. And I can't personally invest in those things because I can't underwrite good IRR,
Hmm.
knowing the starting valuations. Now going to biotech, I'm not like a software guy going into a biotech thing. And I hear you because my background is more software or data or computer science or math or et
Hmm.
cetera. So it makes more sense that I'm aligned with the software companies and tech companies for sure. But again, tough to underwrite good returns there. So that's why, as much as I should probably be owning those stocks, it's the stock side of me says I don't think I can justify it. On the biotech side, however, um, two things. Two of my best friends, we all went to college together. One just got his PhD in mushrooms and microbiology, funny enough. But yeah, he studied microbiome back in the day when we were at UCLA. And then my other best friend is a doctor now, cardiologist, and he studied biochemistry undergrad back when we were in
Hmm.
school. So, we're all science, math guys, and I would always hang out with them, and so they were always talking about all sorts of bio stuff. I actually never studied bio. I studied chemistry, physics, and all that stuff, but I never got into bio. But my two best friends were always talking about it, and so I was always really interested in it. And as like a industry, biotech made a lot of sense to me because we're able to cure things and do things. And um, I would say that I've been investing in bios as like a percentage of my portfolio for several years because it's just a sector that interests me and fascinates me. But yeah, I'm not a biologist. I'm not a PhD in this stuff. A lot of the times I would be more so investing in things that you would actually be very comfortable understanding. Like I mentioned, like a Shockwave Medical before, which is that's a medical device company which has FDA approval, has a
Hmm.
product in the market. At that point, it's a matter of just understanding what's their addressable market, what are their margins, what's their growth going to look like, and what's the
Hmm.
longevity of that. And then that because it's in like the healthcare sector, that they're going to have more resilient revenues and cash flows in a downturn. So that should probably earn it a premium multiple. So my thought is, it's like I was mostly focusing on businesses that already had FDA approval. It's only recently that I've been kind of dabbling in these kind of clinical companies that are preclinical or not preclinical, but they're pre-commercial. So they are still in like phase three typically. I've had a couple phase twos. Those I would say I'm no expert. I seriously have no idea in terms of some of them. But like I have built over time with being very generous with my amounts of postings and not just in general stocks like software and tech and other sectors, but I posted a lot about med devices. I posted a lot about different bio companies as well. Over time, I've actually like earned follows from people who are way, way, way smarter than me in the biosphere. And I've just been talking to them for years at this point. And so I source a lot of my ideas from the network of investors that I've built over the years. Like, for example, we talked about Atlas Engineered Products. What do I know about Canadian real estate? Nothing. But I know a guy who knows the
Hmm.
management team or whatever. And so, like, Then we get a pitch together, and then it's like the numbers make sense to me. So I'm a numbers guy at the end of the day. Like I think my biggest skill is not like understanding a specific sector inside and out, but it's more like understanding if the numbers make sense for a good investment. So I think
Hmm.
biotech is no different than that. I think that from a clinical standpoint, I have very little exposure. Well, I shouldn't say that now. Right now, I have a lot of exposure in clinical biotechs, but the ones that I have exposure in have already reported their positive, very strong data. And I rely on the folks that, for those specifically, the clinical ones, I rely on folks that are way smarter than me in this field and basically tell me, hey, look, this data was so incredibly strong. It is much better than a lot of their peers. This um, this drug, this treatment can have, peak sales of $2 billion, $5 billion. That means that this stock can easily sell for 10, 12, $15 billion. Stocks
Hmm.
trading at $6 billion. Abivax is one. I was lucky enough to be in that one pre their data readout. The stock went up from $10 and now at $80, which is crazy. One of the biggest winners of the year for sure. I only size things before a readout, a data readout, very small. We're talking 1.5, maybe 2% positions. Still a very big win. But then after the data readout is when I actually size those positions up higher because I don't think that the stock gets priced to its full potential on day one of the data readout. Like for
Hmm.
example, Cure, UniQure.
Oh,
When
big win.
big win. I wasn't long before the readout. I was not long ClearPoint before the readout because I actually, as much as I love those two stocks,
Hmm.
I would talk to a lot of my friends who are bio experts, and they would say, I'm not sure about the data that's going to come out. I said, look,
Hmm.
if you're not sure, I'm definitely not sure. So I said, I'd rather watch this thing go up and then I
Yeah.
buy it after. And that means that it's been de-risked. So for example, UniQure, I wish I lived on the East Coast because I couldn't be up early enough for that data. But you could have bought that stock at like 25 or $30 pre-market or something like that. And they finished the day at 50.
Hmm.
So you could have still doubled your money after the data readout in the same day, right?
Yeah.
Which is nuts. And I still when I woke up, again, I'm West Coast times. I bought the stock at 40 and it's at like 53 right now. And the
Hmm.
volume keeps coming in higher and higher. So 40 to 53 with like very little risk is not a bad trade. I mean, in 3 days time after the data is read out, right? And I think that that
Hmm.
stock can even go higher. And that's because of the peak sales of the company and it's the first treatment in that space and all those things need to be accounted for. Like so I do have a lot of clinical exposure right now. It's not something that I would typically do, but what I'm trying to say is that I only size up those positions after the binary event.
Hmm.
And then I'm able to capture that value, the spread between what the stock is trading at and what the stock should technically be worth based on the peak sales and the strength of that data.
Hmm.
And once it can re-rate closer to that level or the stock gets bought out, that's when I would probably exit the position. So several of the bio holdings I have right now, a lot of the bio exposure I have right now are, in my view, either undervalued based on the data they've already reported
Hmm.
or good buyout candidates and still undervalued based on, the data they've reported. So, and then otherwise, I try to stick to more commercial stage companies because, you also could do this very well. You could, look at those companies and say, hey, look, this company, for example, let me give one example. SNDX, Syndax Pharmaceuticals, this is a big winner this year. Um, it basically went up like 80% in a week recently because they reported good earnings and the stock was trading at $800 million market cap. It had $600 million in cash. So they had a $200 million enterprise value. This is a stock
Hmm.
that had two drugs that were already FDA approved and they were in their first or second quarter of launch. And the launch metrics were really strong. They were already combined at an annual run rate revenue of like $200 million. So this
Hmm.
stock was basically trading at an EV of one times EV to sales valuation headed into their earnings. And their earnings were very strong and
Hmm.
it showed that like it was accelerating in growth. So that's a clinical situation. I'm sorry, that's a commercial situation. They're past clinical trials. They have two
Hmm.
drugs already fully approved by the FDA out in the market. They have so there's PDUFAs, which are like when the FDA is supposed to either approve or reject the drug. That's after the phase 3, etc. But then after a drug comes onto the market, they might do further trials. And the point of those further trials is to see if their drug will also be helpful or impactful for patients of a separate adjacent disease or something like that, or treatment. So then they can basically submit SNDAs, which is supplemental new drug applications, which means that they can expand the TAM, or the peak sales number of their current drug that's already FDA approved. So there's ways that companies can actually increase their number of sales expected. So like Syndax is one that they're waiting on an approval right now for one of their SNDAs, which will expand their peak sales further. But again, you were buying this thing a couple months ago, literally a couple months ago, at 200 million EV. They had $600 million in cash, and it was trading at 1 times EV to sales. I mean, based on their first quarter of launch, I mean, each
Hmm.
of those drugs can do $500 million in peak sales. So, and then if you're conservative, you slap a 2 times multiple on peak sales, and that should help you get. So again, now I'm talking about, peak sales is the metric to use when it comes to commercial or clinical stage
Hmm.
biotechs. That's the measuring stick there. And you can be as conservative or aggressive as you want with those things. If you say 2 times, that's fairly conservative. And then some people will say 3 to 5 times. And that's how you get some people saying, oh, UniQure is a 5 to 10x from here. I don't agree with that, but it definitely could see some upside from here, even if you're
Hmm.
conservative. So, anyways, I sorry, I talked a lot, but
Oh,
the
it's
bios
interesting
are
perspective.
businesses. Yeah, yeah. I mean, the bios are other businesses, right? At the
Hmm.
end of the day, they have a product, they have customers, patients, and
Hmm.
it's a business with margins and et cetera. So especially if you remove the aspect of um, like let's say clinical companies where you don't need to guess the binary event, like let's say they're already commercially approved, then it's just studying any other business and there's no real difference. And it's like,
Hmm.
yeah, you could say, oh, there could be new entrants or whatever, but that could happen in any industry. So just because there's another, competitor in trials, then you have to think about actually this business might be even better than other industries because one, they're going to have more resilient cash flows because if we have an economic downturn, there's still going to be patients needing treatment. And then on top of that, they have like they have like a moat, which is a regulatory moat, right? Because people can't just enter the market; they have to get FDA approval.
Yeah.
So these are that's why these businesses are so awesome to study, and they're doing obviously greatness for humanity. So that's a bonus point. But anyway, sorry, I talked a lot about biotech, so I'll stop there.
Oh, it is interesting. Yeah, for me personally, the only biotech I have been invested in is I'm not sure if you heard of it. It's the ticker is VKTX, so the weight loss drug. And yeah, I basically take a look at the data from the phase one. I chatted with ChatGPT a lot, saying like, "Hey, how does it compare with Manjaro and all this stuff?" And I got convinced. I went to the Twitter. I found some Substack links where people a lot smarter than me describe it. And yeah, I fall into the story. I read. So the interesting part is when the phase two trial came out, so the data was available, the stock went up from like 40 to 60 in a minute. And then it went down from 60 to, I say, like 25. And I was like, I just woke up because I'm in the same time zone as you. I'm in the PST. I just woke up. I saw that the broker tells me like, hey, there's a huge spike. Hey, there's a huge downside. I read through the data. I'm like, the data makes sense. It's actually good. Why is it down so much? And I still couldn't figure this out. And I was like, okay, it's just not for me. I will just stick to my software, to other like boring businesses. But yeah, interesting to hear that
Yeah,
you
what I
are.
can say,
Mhm.
sorry,
Go ahead.
just on VKTX,
Yeah.
I do my best to
Hmm.
avoid stocks that a lot of retail investors are invested in. And that's why, like, when you look at my portfolio, you're like, what is this stock? And it's
Yeah,
because
no idea.
And I'm not trying to be like contrarian or something. I'm not saying that. I'm not saying I'm contrarian. I'm not even saying I'm trying to pick other stocks for the sake of picking other stocks and not. I just don't like the noise and volatility around a lot of the retail stocks. I think they trade worse, in my opinion. Like,
Hmm.
obviously, a name like Nebius has done you extremely well, even though that has become basically a retail favorite. Um, I think especially because you had the background to have that conviction, totally
Hmm.
makes sense that you had that stock, and it's been an absolute monster having that Microsoft deal very big. But when it comes to a lot of these retail stocks, and again, like there's some that are just doing so well, like even SoFi or Lemonade, right? Like, you know,
Hmm.
I don't know. Sometimes the shareholder base really gets to me, and I can't really like be. I feel like sometimes I like read some of these things on these tickers, and I'm like, I don't know if I could like. I don't want to be. I don't know. I'm trying not to be rude, but like I'm trying not to. Some of the things I read are like, this isn't like. I don't know. I get that there's like merit, investing merit with some of these names, but I just see the sentiment, and I just don't want to be a part of it. And I think VKTX fits that bill of like it's like a lot of the specialists in biotech that I talk to, they avoid that one like the plague. They don't
Hmm.
take it too seriously. I think that they've pointed out a lot of problems with it. And for me, it's just been an avoid stock on multiple fronts. One being that it's retail heavy, and two being that a lot of the special like bio specialists have basically like avoided that stock. And they've actually been talking about names like MTSR, which just was bought up by Pfizer for 7.3 billion. So it's
Hmm.
like that's the ones that the bio specialists were actually looking at in the GLP-1 space. So,
Hmm.
I'd rather, I think when it comes to bios, you understand Nebius, but like understanding VKTX is a whole other ball game.
Yeah.
And I think sometimes it's best that if you're interested in a sector is like to find people who are know more about the sector than you and just learning from
Hmm.
them and trying to curate your feed to figuring out who those people are. And like for example, if I and I'm probably a bad example of this, but like if I look up a biotech ticker and the only posts that I see on Twitter are like traders, then I immediately avoid that stock. If
Hmm.
I look up a biotech ticker and it's like these like 3 to 5 names of people that I've constantly seen in other biotech stocks that are talking about other biotech stocks. So I'm like, oh, I recognize these names. And then I read their conversation and I say, oh, these guys are really smart. They're talking about the
Hmm.
science and they're talking about like they're not talking about the stock. They're talking about the actual drug and like
Hmm.
and then they're talking about like the actual like they're very in depth about things. Like a lot of it goes over my head, but that gives me a lot more like this stock has credibility, this drug has credibility. And so I just use like the quality. I'm just using whatever information I can. And some of that is just like the quality of conversation that's happening around this stock is like gives me more, okay, I should look into this one or I should avoid this one, basically.
Hmm. Okay. And I guess for the last topic, I just wanted to hear your perspective in terms of the trading. Trading is something that I am still learning. I'm more of the fundamental investor where I read 10Ks. I don't care about the volatility. I just say like what's the market cap and what's the like a future might be if management executes. And you said that you are doing some trading right now. Can you elaborate like how did you like find the trading and do you think it is useful in your day-to-day activity?
I think it's probably the most useful thing in my day to day,
Mm-hmm.
mostly because we are fundamental investors at heart. I agree with you. Um, I think that's very important, understanding the fundamental picture, the valuation, etc. But I use technicals as a way to manage my risk, which means
Mm-hmm.
that even though I may love a story, the price action could tell me something that maybe I'm missing something. And sometimes I'm not. For example, right? Like, if you know like machine learning, then sometimes you have like the tables where you calculate like false positives and false
Mm-hmm.
negatives, right? So like a lot of like sometimes technicals can give you a false positive. And that's not good because you might end up saying, oh, this stock is too risky now because it lost this support level. And then the stock ends up ripping higher and you're like, dang it, I shouldn't have exited, blah, blah, blah.
Mm-hmm.
But then there's a lot of times, and I would say more often than not, that I follow the technicals. It loses the 50-day moving average or something like that. That's an example. And I exit the stock and I say, I will revisit it when it can reclaim this with strength.
Mm-hmm.
And I just watch that stock just continue to make new lows. And I say,
Mm-hmm.
thank God that I didn't, that I listened to something other than my own bias. Like there's so many stocks where I love them, but if I can just exhibit that, if I could see that the pattern and behavior that the stock is exhibiting is weakness, then I want to avoid weak stocks. And so that sometimes causes a lot of over trading, but I would say more often than not, it has saved me. And so I can always re-enter the stock, right? Like there's no
Mm-hmm.
issue, like I don't have a hold. Like here's one thing. So I can exit a stock. Let's say I take a 10% loss. I can use those losses. I'm trading mostly in a taxable brokerage account. I have a lot of
Mm-hmm.
realized gains this year. I take a 10% loss on a 5% position. I get to write off some of my gains this year.
Hmm.
Not the end of the world, no big deal. And then, if 30 days pass, obviously I get to book that loss and it's not a wash sale. But let's say it's within those 30 days and the stock regains strength. I actually have a couple stocks like right now. Gap is one that I was long, and actually you might like that as a
Oh,
fundamental
really?
investor.
Yeah,
Yeah,
I do. Yeah, I did some research. I still prefer BF Corp though, but yeah, it's a really interesting story with Gap.
wait, BF Corp, what do they own?
It's North Face, it's Vans,
Oh,
it's
got it,
Timberland.
got it, got it, got it. Yeah, well, I mean, the quick pitch on Gap is that one, it trades at like 6 times EV to earnings right now at this price, which is extremely cheap. And they have huge growth right now because of in the Gap brand specifically. So Gap actually owns 4 brands. They own like Athletica, Old Navy, Banana Republic, and Gap. Gap only makes up 23% of their store locations. So it's not a pure play on Gap, but Gap has been doing like this killer marketing campaign where their like followers are growing like crazy. They had a cat's eye ad that had like 8 billion impressions or something across social. So a very big moment. It's kind of like a Sydney Sweeney moment for American Eagle. But the thing is like Sydney Sweeney and American Eagle, that worked out really well because
Hmm.
American Eagle is a pure play on American Eagle, whereas Gap isn't a pure play on Gap,
Yeah.
right? They have the other businesses. So it's a little tougher. But like for example, like that stock looked extremely strong, but it
Hmm.
continues to just get sold. Like every momentum gets crushed. Like if you look at the candles on the daily, it looks like every time it goes up, they sell it down. Goes up, sell it down. Makes new lows, makes new lows. So it's like I actually think that that stock at some point is just going to rip to the upside. And if it doesn't happen by the next earnings, I think it will probably happen on the next earnings. But I had to exit that stock in the meantime. I was sitting in calls and I was just bleeding every day. And I was just thinking, this is an example of like something where it's like, okay, if I wait 30 days, I can book that loss and hopefully I can get in before the next earnings.
Hmm.
Or if I see that the stock is able to reclaim the 200-day moving average, or shows me some strength, or shows me signs that the stock on a technical basis has bottomed, then I can re-enter the stock with a little bit more conviction. Because now the fundamental picture has always looked good, but now on
Hmm.
top of that, you have the technical picture that's shaping up. So having more confluence of information to me helps your ability to be in a profitable position. So I think the reason why technicals are good is because you prioritize positive returns over max possible returns.
Hmm.
So I think it's just an understanding of like reducing your losses and increasing the odds of being profitable. That's what technicals are good for. And fundamentals are good for scoring big wins, and you need the fundamental tailwind to work. So I would look at fundamentals as more of like strategy, and I would look at technicals as more of tactics. That's kind of
Hmm.
how I like. So fundamentals are like how I get up there. Technicals are kind of like the in between of how I optimize that way to get there.
Hmm. Does it interrupt your say day-to-day work or education? You said you are studying master degree, and at the same time, like let's say you have a class and you still need to take a look at the technicals, whether for example, the stock lost the 50 days moving average. Like, does it interrupt you from your like main focus, or like trading and stock is your like main priority right now?
Look, I don't day trade, which means
Hmm.
that I'm not in and out of a stock intraday. I mean, I could be. That
Hmm.
does happen from time to time, but here's how I'll say it. Um, I will look through my stocks that I own in my watch list. I own all of these stocks. I will look at, some of the stocks that are on my watch list that I don't own. And what I'll do is like every hour or so, I'll take a look and I'll say, oh, look, this stock is down 7%, right? And then I'll say, let me look up the chart. And so I'll pull up. So basically, I use the price action on that day to
Hmm.
tell me if it's up a lot or down a lot. And then that will tell me if it's worth looking at a stock. If a stock is just like up or down, plus minus 3%, it's not
Hmm.
like anything. But if it's like more of a drastic move, it's kind of like my trigger to look a little further. So I don't
Hmm.
need to look through all 30 or 40 stocks that I have on my watch list. I just need to look at the ones that are like I look from a price action perspective and say, this one's down again today. Yesterday it was down 3%. Yesterday, the day before it was down 6%. Today it's down 7%. What's going on with the stock? And it's like, oh look, now the volume is decreasing and it's sitting right at the 200-day moving average. You know what? I'm going to take a swing here because I just looked at the chart and I'm going to take a swing because the volume is
Hmm.
declining. And then I take a position. Now, hopefully, I just caught a bottom and the stock bounces and look, it touched the 200-day moving average and it bounced perfectly.
Hmm.
Or it craps out by the end of the day and it and it closes below the 200-day moving average, in which case I'll say, damn it, it closed below. I have to respect my rules. I took a 2-3% loss. I cut it and it's back on my watch list, and I will wait to see if it can reclaim this with strength. Then maybe in a couple days, I see that the stock is up 5-10%. Sure, maybe I lost that. Maybe I took a small loss. Maybe I didn't get that first run. But my percentage likelihood, my probabilities of being profitable are more likely when the technicals are in my favor. So even though I might not get that max profit, or you know what I mean? There might be like a
Hmm.
little bit of inefficiencies in how I manage that position. But I think that like the trade-off between sitting in a position that could have kept tanking for the next, like, we don't know if it was gonna like fall below the 200-day and then reclaim it in the next 5 days. We don't know that.
Hmm.
It could have also just kept tanking, and there was a fundamental reason behind that. And maybe some investors were dumping the stock, and that the selling pressure is overwhelming the stock to the downside. And what we didn't know is that the trading price and action of like a stock can tell you something that you might not even understand at some point, and it has to do with the fundamental case. It could be
Hmm.
that like some big fund has done their channel checks and know that, oh goodness, they're gonna miss their next earnings, or they're gonna lose this contract or something like that. Maybe they did some channel checks and they realized that, and that's why the stock is acting as weak as it is. So it's possible that the technicals are actually conveying information to us about the fundamentals, and so that's why it's important to listen to the technicals, because they're telling you if somebody is like has desire to own this stock or has desire to leave this stock. And if
Hmm.
somebody bigger than you and with more resources than you is leaving a stock, why would we take the contrarian bet when they probably have better information than us? So I think, that's, yeah, that's kind of where I net out, is like I listen to it because I think that someone might know more than me. So I think
Hmm.
when you take away, like, I don't want to be arrogant and say, oh no, my fundamental thesis is, rock solid. It's like maybe, or maybe there's information I don't know yet. So I manage that position with paranoia.
Okay. Yeah, interesting perspective. I think we are almost on an hour. Yeah, thank you. It's a really great conversation. I think it will be great to have a part two because there are so many things that I think I can share with the listeners if you are interested. Before
Yeah.
we go, I always try to ask all the guests, is there any book or TV series outside of investing that you recently read or watched that you would like to recommend to the listeners?
Let's think. You know, actually I just saw that they released Alice in Borderlands season 3. I don't know if you've heard of Alice in Borderlands. It's a Netflix
Yeah,
show.
I just started watching the third season.
Okay, so you like the first two.
Yeah, yeah.
Okay. All right, good. I think that's probably, I mean, I haven't started watching the third season. Honestly, I thought they should have probably ended it after the second season. I thought it was a perfect ending. So I'm
Hmm.
a little confused why they're doing a third season. I hope I'm not disappointed. But what I can say is like seeing that they dropped the season 3 made me think, okay, my recommendation is if anyone hasn't seen the first 2 seasons of Alice in Borderlands, that I can 100% vouch for, and it is an incredible show. And it seems like you agree with me. Like Squid Games was good and it was interesting and exciting because the stakes are high. But I
Hmm.
think that like the games and like the cleverness of Alice in Borderlands is much more fun, and like the games that they play are way more interesting.
Hmm.
So I thought, yeah, I would say Alice in Borderlands is something that people should watch if they haven't. So I don't know. That's the first thing that came to my mind.
Yeah, I would like to recommend you this third season too. Like, just think
Okay.
about it as a like a separate show. Don't compare it with the first and second season. It's good
Okay.
as it is.
Good to hear
Uh,
that. Fantastic.
yeah. Thank you, Logical. It was nice talking to you. So, any final words before we go?
Um, yeah, I guess last thing I would say is that market is fun right now. It's been up and to the right, but be ready for pullbacks. Be, able to pivot if you feel overexposed to anything. Then if you feel stress ever, then maybe you feel like have too much exposure to something and it's not making you feel right. So just make sure that no matter what you do in investing, don't hurt yourself. Always like be cautious and understand like the risk you're taking and fully understand that. And we will have pullbacks, we will have corrections. If we don't, then this market's going to have a melt up, which if it does, then then we're gonna have an even bigger correction at some point. So at some, we're just kicking the can down the road. Eventually, a correction will come. So just be ready for that and manage your risk appropriately. That's all.